Welcome back to the ET Money Show, and let's continue with the first discussion that we have lined up for you today. The Finance Ministry recently has hiked the interest rates for the several small savings schemes by up to 100 basis points. While the new rates will be applicable from January to March, a status quo has been maintained in the case of PPF and Sukanya Samriddhi scheme. And on to the ET Money Show, we will tell you all that you need to know about these rate hike and how it will impact your saving and investments going ahead. Let me bring on board Shweta Jain of Investography. A very good evening, Shweta. Thank you so much for joining us today on ET Now, and a very happy new year to you.
Good evening, Srishti. Thank you for having me. Happy New Year to you.
Thank you so much, Shweta. I think the government has also given the New Year gift to all their investors, and some of the new investors that are looking forward to invest in all of these small saving schemes. Out of the 12 saving schemes, 8 have gone through the rate hikes that we have been recently notified about. Just wanted to understand from you which one of these schemes has seen the most of the hikes happening, and which were as per your expectations on these fronts, because the industry was also expecting some of the rate hikes to come in and kick in by the start of this January month, isn't it?
Yes. So I think the expectation and delivery both have been a little different this time. If I actually see the small savings schemes that have been impacted, I feel like the government is favoring the retired people more. Because senior citizen savings scheme has been increased from 7.6% to 8%, and post office monthly income scheme also has been increased from 6.7% to 7.1%. These are two schemes which are very popular with retired people, not so much with the younger generation. So the younger lot prefer to start off with PPF, and that's what we recommend as well, because it has been one of the good tax saving investments, good debt guaranteed investments of a sort. So PPF, there has been no increase, and we also have recommended Sukanya Samriddhi to younger people, right? Because parents of girl children do start off with Sukanya Samriddhi. So somewhere I feel the government is biased towards the retirees than the younger people, but there is, I think, light for the younger guys as well, because term deposits for up 1 year, 2 years, 5 years, those have been increased as well, of different variations of different tenures. So that has been increased. Kisan Vikas Patra hasn't been increased, hasn't been changed. National Savings Certificate, which is one of, again, very popular with younger guys for saving taxes, 7% from 6.8%. Not very large, but it has been increased a little bit. So these have been some very important changes, because as inflation has risen, we have not seen these changes for quite some time. And even with the increase in interest rates, we've seen FD rates move, but the other saving schemes, the small saving schemes, we've not seen the increase for a long time now. So I think this is a welcome change for sure.
Okay, that's the welcome change for sure. But Shweta, like you have been mentioning, that the government, you feel so, that has been favoring most of the retirees, and the senior savings scheme, the rate hike is more lucrative there. But just wanting to understand from you, from somebody who is a senior citizen and watching out this show, what will be your advice with the rate hikes? Are these rates lucrative enough to enter at these levels, or apart from that, there is something that they need to be looking out for, any other option that you have for them?
So for retirees, I would definitely recommend that you make sure that your assets or your corpus outlives you, for sure, because this is not a time that you can take too much risk, but this is also not a time where you can your funds can outgo, right? And you will be left with no money because of inflation. What you need for your living expenses today will be very different from what it is going to be needed 10 years down the line due to inflation. You probably need, if not more, at least double the same amount. So your money has to grow accordingly. So I would recommend a mix of small saving schemes like senior citizens savings scheme, monthly income scheme, where you have a regular and fixed cash flow. But understand that this is the safe money. You also need some amount of equity exposure depending on your corpus. Even if you're 60 years old, you do need some bit of equity exposure. Could be 10%, could be 25%, depending on how much is your corpus and how much is your living expense. That is something that you'll have to calculate. But equity, you would still need a little bit, if not too much. There are also debt mutual funds, which of course are not guaranteed, but there are good debt mutual funds where you can look at investing apart from these small saving schemes.
Okay, but let's talk about a different age group, somebody who is looking to invest and have a moderate risk appetite as well, Shweta, because what I feel is that a lot of investors still look at to FDs for very risk-free sort of a return. And if you will see, the highest of the lot, that is 5-year time deposit, is offering you a 7%. When we see inflation is near about 6 odd percent, so somebody who is now looking to invest into FDs, what will be your suggestion looking like? Given the kind of volatility in the equity markets, will you be in favor of going for FDs or some partial investments out there?
So I'm not a fan of FDs for 5 years, even if it's 7%. The only reason it's 7% is because inflation is high. Let's understand that. They don't call inflation a silent killer for nothing. So your FD should be for 1 or 2 years. It shouldn't really be for more than that. It's your emergency money. You have debt funds today, which give you tax benefit post 3 years, right? So even if it was 6% similar or 7% as it is today, if you earn a similar amount in debt funds, you would still end up making more post tax versus your FDs, because FDs are taxable. So just to give you perspective, if you're getting 7% in an FD and you're in the 30% tax bracket, which a lot of youngsters today are who go for FDs, to be honest, you will be paying 2.1% of this as taxes. So you will actually be making only 4.9%. So are you okay with 4.9% when inflation is at least 6%? If not, then you need to understand what risk is and what volatility is. If your time horizon is 5 years, there's no reason why you can't do a balanced advantage fund, or no reason why you can't do some bit in equity at least. FDs for me, for that reason, is not the answer. For a moderate kind of investor, balanced advantage or debt and equity individually will make much more sense.
Okay, so that's the advice coming in for somebody who is in that moderate risk-taking capacity. But out of the lot of 12 small savings schemes, Shweta, if I have to tell you that you need to pick up one, what will that will be, and what will be your advice for which particular age group that you wish to have that advice? Because a lot of rate hikes is what the government did try to come up with in this rate hike revision, but they are still not lucrative enough. So apart from the whole lot, if you have to pick up one, which one would that be?
I think I would choose senior citizen savings scheme.
Okay.
It is 8%, and it's for the retired, right? So they like something which is stable, steady, and 8%. Honestly, it's not that bad as 7%. It's better. So I would go with senior citizen savings scheme.
Sorry, I don't know that. So that's the advice coming in if Shweta has to pick up one. But Shweta, keeping in view, there are a lot of factors at play. The equity markets are still volatile. The debt investment is still not have cashed up from the retail side. We hope that in 2023, the retail participation is also that much. But looking at the small savings schemes, a lot of people do try to invest in these FDs and maybe keeping their money in the small savings account. If somebody has to plan now in terms of allocation, what will be your suggestion on allocating if somebody really has to invest in all of these small savings schemes, that apart from maybe 100 rupees, how much they should be looking out to invest and secure in these sort of schemes?
So I would say PPF is a great option. NSE is okay. I'm not really a fan of NSE, but PPF is a good option for somebody to start investing. A lot of young people look at post office MIS. I would definitely not recommend that. Sukanya Samriddhi is a good option for people with daughters, even at the current rate. So if it's a PPF, you can invest up to 1.5 lakhs, and compounding there works great. And I think PPF, the government will definitely look at this in the next cycle, and even Sukanya Samriddhi. So out of 100 rupees, I would say somebody could look at, say, 10 to 20 rupees in smaller savings schemes such as these. It gives you that sense of certainty. Maybe the next 6 months expenses in your FDs and bank account. So that may be another 15-20%. So your 40% is sorted. For the rest 60%, you can then comfortably look at long term. What these saving schemes, for me, how I look at them is that it gives you a cushion to help you stay invested in long term in equity. So whatever the volatility is, and which we will see increasingly, over the next few years, and returns coming down. So, but still, equity is something that you will need to look at for long term. I would say decade, 2 decades, if not just 5 years. So you will then comfortably put about 40% of your money in equity and be invested. I think more than investing in equity, we need to make sure people stay invested in equity. And for me, saving schemes, FDs do that, debt funds do that, that this 50-60% gives you that cushion that your 40% is invested and growing.
Okay, but with this, we'll let you go on that, Shweta. Thank you so much for joining us today on ET Now and helping our viewers know all about the rate hike in small savings scheme that the government has recently announced, and in that as well, depending on the different age categories, what could be your best pick amongst them all. Thank you so much.
Thank you, Sushti.